Welcome into Chit Chat Stocks. We have a fantastic episode coming up, but first, let's talk about our presenting sponsor, Public.com. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at Public.com. That's a pretty big deal, because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment-grade corporate bonds. So, while other people are watching their returns shrink, you can sit back with regular interest payments. But you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chitchat stocks. Brought to you by Public Investing, member of FINRA plus SIPC. As of September 26, 2024, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosure/bond-account for more info.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Our strategy of positioning Celsius as a global beverage leader for health-minded consumers remains our top priority. We continued our expansion further in traditional retail with great success, and we positioned the company for future growth with expanded roles within our ranks. In addition, we brought on high-performance individuals with diverse backgrounds and experience. John Fieldy, the CEO of Celsius. Welcome into Chit Chat Stocks. My name is Brett Schaefer, and as always, joined by Ryan Henderson. Ryan, I've done a lot of research on Celsius over the past month or so, and I want to play a little game with you. What year do you think that quote from Celsius was?
Oof. 2020.
Fairly close. 2018.
Wow.
Yeah. See, I think that, and the reason I said that and wanted to play that game is because, and we'll talk about this throughout the episode, the company has consistent branding and consistent focus. That quote could have been from 2013, could have been from 2018, well, it was from 2018, or it could have been last quarter, because that's the same thing they've been saying for years and years and years. Let's get into this episode. This episode's one of our stock research ones. We're covering, as you might know, Celsius Holdings, energy drink brand, taking a ton of market share. I don't know what else to call them. Very popular among younger consumers, healthier, sugar-free, and one of the top performing stocks of the last 5 to 7 years. I think at one point it was a 100-bagger over a 5-year period, which is incredible. I think definitely a 100-bagger from the lows when the CEO took, he didn't take over in 2012, but came onto the company with a kind of turnaround management team in 2012. We're going to get into it. This episode is a stock research podcast from me. We're going to get feedback and questions from Ryan, and then we're hopefully going to get to an actionable decision of whether I'm buying, selling, or keeping the stock on my watch list. I should say, before recording this, or as we're recording this, I don't own any shares of Celsius, have not in the past, but we're going to decide by the end of the episode whether it belongs in my portfolio. Other news and notes. There's going to be a newsletter with charts along with this episode that you can find for free on the Chit Chat Stocks Substack. The link for that will be in the show notes. You can follow us on Twitter, YouTube, Spotify, Apple Podcasts to get all of the shows every time they're released, Wednesday or Sunday. And lastly, important, because I know that the stock's been a bit volatile, so I don't want to feel stale here. We're recording this on September 25th. So 2 weeks, I think, before this will come out. Hopefully it won't be stale. There's no earnings before then, but if any news happens between now and then, we didn't talk about it because, well, we're not time travelers.
Yes, and just to fact check you, Brett, over the last 10 years, it's up 16,847%. So a 168 bagger, roughly, over the last 10 years. It was, at one point, a 500 bagger less than a year ago. So it's had quite the drop, which we're going to talk about. And this may blow your mind, and I might have to go double check this. But its total return since IPO. Can you guess that?
Well, I think the stock was actually way higher than those 2012 lows at the IPO. So maybe 500%, 300%, something like that.
It's only up 94%
Oh, hey, if you held, you're positive now.
since 2007. After this ride, it's only up 94%. That is, I have no idea that was possible.
I wonder if there's any bag holders that have held on since 2007. I'm guessing zero.
I think
Just
even the
because,
founder's gone. All right.
yeah.
So, yeah. Let's go through this though. Let's talk about the history because it's a very unique story. And it's always fascinating to learn how brands kind of emerge through the ranks in already solidified categories. And Celsius has done just that. So why has Celsius succeeded? Why did they break through and become the third category leader in energy drinks?
So, in order to tell the modern history of Celsius, we need to look back at when current CEO John Fieldy took over as CFO in 2012. Here's a GQ interview that I think I'll link in the newsletter, but if you search GQ, John Fieldy, GQ Celsius, it'll pop up. I thought it was a fantastic interview, and he really was open with the interviewer about how he runs Celsius and his management philosophy. So, here's the quote. January 2012, the company was struggling. In the first 90 days after I started, we got delisted out of Costco, which represented about 60% of our revenue. Then we got delisted out of other retailers. At that point, I didn't think I was going to have a job in 6 months. We went back to the basics. We knew that we needed to build a strong foundation of loyal consumers. Loyalty is the only name of the game in consumer products. You can get trial, but if you can't build loyalty, you won't be able to build a brand. So we focused on continuing to build this loyal consumer within the fitness community. That's a slow road. It's not flashy for investors, but Carl saw the bigger opportunity. We wound up getting the company to be profitable in late 2015. So, back in 2012, new management took over Celsius Holdings. They decided the brand needed a turnaround and better positioning in the energy drink category. Ever since, Celsius energy drinks have been focused on fitness, health, and being a good for you drink. So, progress was slow at first. They were a small enterprise. We look at the revenue. I'll have a chart that we can share in here. Revenue was well under $50 million. I think we go back to December 2014. That's $14.6 million. So quite low. And they even had, they were way too overextended. They were selling in China. They were selling in Europe. I mean, that's just too much international expansion for a company that small. But for the last 5 to 7 years, Celsius decided to, well, and even longer than that, they focused on the United States market. They built brand loyalty and awareness through fitness, which would be, say, gym distribution, influencers online, and other things like that. And they focused on distribution through Amazon, where they could get better visual from a consumer and maybe work those sponsored listings, work with the search results, kind of the SEO on that, versus convenience and grocery stores where Monster and Red Bull are going to dominate that distribution. And it worked wonderfully. The counter positioning versus Red Bull and Monster worked like a charm. Many people, especially women, are turned off from the brand perception of Monster and Red Bull. There's a certain, I'll call it stink to it, similar to cigarettes. Probably not as bad as cigarettes, but the traditional products are loaded with sugar. They taste funky, and they market across the extreme sports and a lot of what I'll call in air quotes bros. Do you agree with that statement? And Celsius, sugar free, tastes better, focused on fitness and health. It was almost the complete opposite. And they said, look, we know people want caffeine, but you don't like Monster and Red Bull, especially drinking them in a non-party situation, at least with Red Bull in that case. And we got a product just for you.
Yeah. Hindsight, it was brilliant counter positioning. Obviously, if you're working at the company at the time, you're probably thinking, like, we just lost Costco. We're losing retailers left and right. We're in a tough spot. Like, it doesn't feel like it's you probably would think I'd rather have Costco and the big retailers than this, but actually switching and pivoting to that fitness community probably better position them for the long run. And it was perfect because I think Monster and Red Bull kind of have this like intense thrill brand to them, which just doesn't quite resonate with women the same way that this fitness and health enthusiast type of messaging does. So, yeah, I think they just did a really good job, carved out a niche. I don't think really any energy drinks had the hyper focus on fitness enthusiasts the way Celsius did at the time.
Yeah, that's exactly right. And we will talk about the numerous copycats coming onto the market from above and below, but that's for another section. And Ryan showed the revenue chart. It's an incredible revenue chart. Revenue in 2014, 14.6 million. Revenue in the last 12 months, $1.49 billion. So that is 100x in revenue in around a decade. And I want to highlight with these quotes and why I did that quote at the beginning and the quote from that GQ interview is the consistency and the scalability of the Celsius strategy. In 2012, they decided to focus on fitness and health, and they have not stopped this messaging ever since. Consistency is key when building brand loyalty. And at first, they work through these small time gyms, smaller social media influencers, because that's what they can afford. But today, they have brands with big brands, or excuse me, deals with big brands such as these college football athletes that are stars, and then something like Inter Miami and the MLS, and success in what I would call the sugar-free category has been led by Celsius. So they have gone and taken the energy drink category from I think around 10 to 20% sugar-free to about 50% sugar-free, and it's almost like, I think a perfect analogy is the transition from regular soda to diet soda over the last, I don't know how long it's been, 50, 100 years, something like that. Probably not 100 years, maybe just a few decades. But that's also spawned a lot of copycats. You got capitalism. You see that Celsius is doing well. This isn't something that's a patent. People can make sugar-free drinks, and they're getting attacked now from both above with Red Bull and Monster, and below with many upstarts trying to get in on the sugar-free energy drink game. We'll get to the competitive threats later into this episode, but first, I want to talk about the wider energy drink category. Why is it so attractive, and what is happening in 2024 to cause all these stocks to fall? Because I should mention here, I think Celsius is down around 70% from all-time highs as we're recording, and that's why we wanted to dive in, do a little dumpster diving with this fallen angel.
Yeah, let me fact check you there real quick. Celsius total drawdown down 68% from recent highs. Yeah, 68%.
Yeah, that's quite the fall, and hopefully, as we'll get into it, the valuation is a little bit better. But yeah, what drives growth here from the category perspective? I guess I kind of asked that one myself, but I'll keep going. Energy drinks were popularized when Red Bull was invented in 1987. Well, I should say energy drinks were popularized outside of Asia because I believe Red Bull, if I'm remembering the history correctly, was actually taken from some sort of a guy found a product in some Asian country. I want to say it's Thailand or China. But he took that and he's like, hey, we have nothing like this in the West. I think people might like it. Boom. Red Bull was born, and they've done the marketing that they've done ever since. And then it was reinvigorated or maybe expanded to mainstream when Monster Energy took off in the 2000s. I would also say that Red Bull is a little bit more European and international focused. Monster, a little more United States focused, although they do have a lot of international exposure now. And for around 35 years, the category has grown its share of the ready-to-drink drink spending, RTD. One thing to note if you're looking at all these investor relations stuff, this category has a lot of acronyms. RTD, MULOC, all that stuff. Sell it through, sell in. It's crazy. But if we look at this chart here, I'll show Monster Beverages revenue, and they've grown a little bit of their market share. Let's see, Celsius Research show notes, and it's just grown by a very consistent amount for the last 2 decades. In 2004, they had $180 million in revenue. In 2024, it says here, which I think is the last 12 months, I'm seeing $7.4 billion. And the reason they've grown is because they took market share, and the energy drink category as a whole has taken a lot of market share from other RTD categories. Fewer people are drinking soda. Fewer people are drinking orange juice. Orange juice, I guess, is smaller. Fewer people are drinking Gatorade. Fewer people are drinking coffee. Fewer people are drinking tea. And a lot of them are switching to products like energy drinks. And they're also opting for, things like carbonated seltzers. Remember LaCroix, Ryan? Remember when that was one of the
Yes.
hottest stocks in the world?
What, National Beverage Corp?
Yeah, something like that. I think it's done okay,
It's
but
done all right.
that's a little bit of a cautionary tale for Celsius. These things don't always turn into just monsters forever and ever and ever. And
Question
yeah,
for you. Do you know when Celsius launched, was it the same branding? Was it still the Celsius energy drink?
I think so, at least from 2012 onwards, and I'm not sure back at the IPO. But I do know that the can used to look a lot different, and now it looks a lot sleeker, which I think is good.
Okay.
Previously, it was maybe more colorful, but I think they understood, and they've talked about how the way the can looks matters when people are holding it.
Definitely. And for context, anyone that doesn't know the Monster story, I recommend going and checking it out. If you remember 20 years ago, maybe a little more, there was a popular canned juice company called Hanson's Natural. That Hanson's Natural has become one of the best performing stocks of all time because I believe it was activist investors initially that were running Hanson's at the time launched Monster, and it has basically become I don't think Hanson's is around anymore, so it is the entire company at this point.
Yeah, well, Hanson's was sold to Coca-Cola, but
Okay.
yeah, it is one of the best performing stocks of all time, and that's why I think people are excited about Celsius as well. And when you look at the entire category, like other CPG brands, energy drinks have been able to employ consistent price increases to drive revenue growth, at least over the long term. Now, we're about to talk about they're struggling this year, but it's not just a volume story. And it's been a long-term volume story, but it's also a pricing power story. It's the perfect combination of, okay, we can raise our prices by about 3% a year. People are still going to shop for our stuff. And we're also going to steal volume from everyone else. You can see this category share in this chart that I don't know if I'll share it here, but I'll include it in the newsletter from the investor relations page. In 2022, 2023, and 2024 so far, demand for other drinks in the RTD category has declined in value while energy drinks have grown. However, and this is why the stocks are falling, 2024 has been a very slow year in energy drinks. Monster Beverage said it was the slowest year besides a short blip in COVID and the GFC in 2008. Why? I think is a tough question to answer. Is the category losing share? Well, no, because look at the rest of beverages. They're still outpacing the rest of beverages and have been for the last 3 years. Is it the weight loss drugs? I know it's a little less popular right now, but remember when everyone said that Ozempic was a category killer for a lot of stuff like this? I doubt it, honestly, because energy drinks are embracing sugar-free due to Celsius. So, if anything, they're lining up with that type of thing and reducing the craving. I think the one idea that makes sense is the K-shaped recovery, where the lower part of the consumer is struggling. I think energy drinks, they're big in convenience stores and they play a bigger role among poorer parts of the population. Monster has said that they think this is the cause. The dollar stores are also struggling, which kind of would line up with that thesis. And it would make sense, and I'm not going to share the chart, but Celsius is gaining more share of the category growth. And if it's a K-shaped recovery, I think that makes a lot of sense because Celsius targets the wealthier part of the energy drink category.
Yeah, I think it was Monster this quarter on the conference call that came out and basically management said, we've never seen an environment like this. The only time that we've seen declines in volume were GFC and COVID, like you mentioned.
Are they the leading recessionary indicators, Ryan? I think they might be.
It's so bizarre. Like you said, maybe it skews towards lower income. the
Maybe, yeah.
products.
Yeah.
I don't know if I've seen anything that states what their typical customer looks like, but yeah, it could be just general consumer weakness in discretionary categories. We've seen that all throughout. Um, I, a lot of the companies reported that this quarter. So K-shaped recovery is really the only one that, out of those answers that you have, makes sense for me. It's not extra competition. Maybe for Monster and Red Bull, Celsius's rise has been a little bit of an inhibitor of growth, but the, the category, it's all slowing.
Yeah. Oh, yeah. I think all this to say, this is why I was spending so much time on this, is because we want to identify whether the slowdown is a Celsius problem or a short-term sector problem. And I think what I came away from and what I came, why I'm positive about this category is because it looks like, from my sense, that this is just a macroeconomic issue for the category, and it's not a long-term problem for energy drinks or Celsius in particular. We are still seeing a big transition to sugar-free caffeinated seltzer, which is essentially what Celsius is. So you have the caffeine and the health-focused stuff. It is just a cohort of the economy and a cohort of the customers that are struggling. I don't think people are going to stop drinking caffeine. I mean, I'm 100% confident in that. And I don't think people will stop wanting a ready-to-drink product in a can with minimal calories, with caffeine, that can replace not only their coffee, their tea, but also their Gatorades, their sports drinks, their orange juices, and their sodas. Yeah. All right. What's great about Celsius, though, is, again, we mentioned that they're taking more and more share of that growth. And I'll share this chart because it's hard to understand because it's almost like the second derivative of the category growth. If we look at their contribution to the dollar growth of the energy category, it went from 0.5% in 2019. So that means if there
Yeah,
was a
this chart always confuses me.
Okay, let me just do it as an example because I know the listeners are probably, it can be hard to wrap your head around without seeing the numbers. So let's say in 2019, if the category grew by $1,000, they would have contributed $5.
It's
But in
essentially the incremental market share.
Yeah, so the incremental market share, if it's a group of dollars that were growing, and so far in 2024, they've contributed 46.5% of the dollar growth. So if there was $1,000 of new spend within the energy drink category, they would have been $465.
In
So
other
that's a
words,
huge difference.
if Celsius did not exist and the category, in this case, they accounted for 46.5% of the new category dollar growth. If Celsius did not exist, the category would have only grown by, 53%? Or it would have grown by more, but it would have been made up by competitors.
No. Yeah, well, the 53% is not the right number. It's more of the, because
Sorry. Yeah, gotcha, right.
$530 of the $1,000. I know it's confusing, but essentially they went from basically none of the category gains from a dollar perspective to half in 2024 so far. And we've seen their share across physical retail plus online, which is their MULO plus from Circana, which is just third-party estimates, because there's a difference between, and this is important, we'll get to it, the sell in to the distribution and then the sell through to the consumers, which is hard to track. But someone like Circana, these third-party analysts, work really hard to do so. So you have this physical retail and online, such as Amazon, and it's looked great from a market share perspective. They now have around 12% market share and are the clear number 3 player in the space. And again, this is due to more people wanting sugar-free energy drinks that have a health twist. They got their B vitamins, their green tea extract. I'm not sure exactly how healthy they are, but people think they are. And the brand perception of Monster and Red Bull, where again, women actually drink Celsius, and the focus on health and wellness is important. Will the growth continue, though? I think we're going to talk about that for the rest of the episode, Ryan.
I have a question for you right now. Do you know what Celsius's market cap is today?
Today?
Don't look.
Well, I looked last night, so I can probably bank on it, like 7.3 billion.
Yeah, it says 7.37. So yeah. It's yeah, I don't know. It surprised me. Feels very low. It is the leader in new dollars spent on energy drinks, right? Is that kind of the way to think of that chart you shared?
Right now, yeah. Well, they're not the majority yet, but 46.5%, pretty close to half
They might be the largest contributor, though.
of the engine wheel. Yeah, especially because we'll have a chart below. Monster is actually lost, at least in the United States. And again, this is definitely just the United States. So international, Red Bull and Monster still dominate. But yeah, look, the last 6 years in the United States have been astoundingly successful for Celsius.
This, I know this isn't that helpful to your analysis, but for any of our international listeners that don't know the Celsius brand, this is extremely popular in the States, especially with younger generations. Wouldn't you agree? We were having a conversation with your friend the other day about how he only drinks Celsius, has a fridge full of Celsius. I know this is anecdotal evidence, but
Yeah.
he's not the only one.
There's also a few copycats that he had, but I think what's interesting is that he associated the Celsius brand with all of those sugar-free ones that are trying to copy them. And that's probably a good thing for them. And one note that I will make, another fact before we move on to kind of the profitability and the income statement here. Celsius claims, I think it makes sense, they can probably track this, that they've introduced, 75% of the customers they get are new energy drink customers. So they're not actually, it's more greenfield. And that might change, as they're creeping up on the market share with Red Bull and Monster, but they've expanded the category, not just stolen stuff from Monster and Red Bull.
I believe it. It feels more, when you look at the energy drink aisle, it feels less intimidating. You don't, not necessarily, like, it doesn't feel like as big of a commitment. If I drink a whole can of Monster, I'm probably going to be up all night. And it feels like, what's this going to do to me? I'm not really sure. If you've never had a can of Monster or a can of Red Bull, for some reason, you look at Celsius and you think, that seems more palatable. Maybe it's the simple can design. Maybe it's that it's associated with fitness. But
yeah, that's true. It's perception because they have the same amount of caffeine, I think. But there is, and it's what I called it earlier. I'll repeat it. There is a little bit of a stink with the Monster ones where you think, oh, it's going to taste gross, loaded with sugar, probably super unhealthy, and I'm going to get wired and crash.
Yeah, this passes the Peter Lynch test with flying colors.
Yeah, exactly. I was thinking throughout this episode, yeah, he would definitely own this thing, especially with the market share taker plus anecdotal evidence and a track record of national expansion.
Yeah, absolutely. Okay, let's talk the unit economics. What profit margins or cash flow margins should we expect as this matures?
This episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is the best aggregator of stock pitches across the internet. By tracking thousands of blogs, newsletters, fun letters, podcasts, and more that collect and summarize the best stock pitches and bring them to you in a single place. Try it for free or upgrade to a paid plan to see investor returns and the latest stock pitches on joinyellowbrick.com/chitchat. We genuinely use Yellowbrick every single week here for stock research on small and microcap ideas, and think you can as well. Try it for yourself. Simply go to joinyellowbrick.com/chitchat and search a company or ticker you're interested in. You are bound to find a great report on just about any company. That's joinyellowbrick.com/chitchat. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on 1,800 stocks. Want to see NVIDIA's data center revenue? FinChat's got it. Like to track Spotify's premium subscribers? They've got that too. And they just added ETFs to the platform as well. The breadth of FinChat's data is truly one of a kind. We use FinChat every day, and I've personally been using the AI Copilot more and more to summarize earnings calls and conference transcripts. To get 15% off any paid plan, go to finchat.io/chitchat. That is finchat.io/chitchat to get 15% off any paid plan today. The link is in the show notes. Yeah, that's the question we want to answer is like, okay, in my estimates for the next 3 to 5 years, like what operating margin should we expect? Should they be radically different than today? Or are they going to be about the same? Or could they go down? So they're pretty easy to understand with Celsius. You have cost of revenue is the variable cost. And this is from their annual report. So I make sure to always check this because uh, I don't know if it's famous, but it's famous among us from the podcast is when we looked at Peloton and they were stuffing a lot of cost of revenue and selling general and administrative expenses. You always just want to check that. Usually it's fine, but there's some companies that can be sneaky. But yeah, this is raw materials, packing fees, warehousing expenses, and the majority of the costs are the raw materials. So essentially, the cans and what's inside the cans. Now, Celsius's gross margin is now 50%. It has gotten closer to Monster's in the last 5 years, and I would not expect margins to climb much further from here. Maybe we can slot in 55% as a ceiling, something like that. But historically, before they got any sort of scale, the gap was much wider between Monster and Celsius. Now, as Celsius has reached a lot more maturity, it's pretty much closed. I don't think we're going to get much leverage from there. The second big expense category is selling, general, and administrative expenses. You have marketing and corporate overhead. From the definition, it's really all things associated with sponsorships, marketing, and look, your payroll costs, your building costs, your corporate employees, everything looks pretty much in place here. SGA and expense was $413 million over the last 12 months, or 28% of revenue. It was 41% of revenue in 2020. I expect to see slight leverage here with this segment as we scale, but probably not too much because they've seen a lot of it already. And this is the type of company where marketing is almost a cost of revenue because you have to keep reinvigorating that brand each and every year. And that's really the basic unit economics that get us down to operating income. Celsius has a operating margin right now of 22.4%. Monster has an operating margin of 28%. So, not too far away. Historically, Monster actually had a higher profit margin of well above 30%. I don't know if I'd bank on Celsius getting there, but who knows? It's possible given that gross margin. And given the similarities of the business, I think banking on about a 25% operating margin for Celsius makes a lot of sense. And I'll have some charts comparing the two in the newsletter. Last note before I let you talk, Ryan, free cash flow conversion has been fairly poor. I expect this to close over time because inventory turnover should be pretty high. That should normalize a little bit more as they scale, but it is definitely something to watch out for. Cash flow conversion matters. And if it isn't converting as fast as we like, returns will suffer over the long haul. I want cash returned to shareholders, not earnings stuck in working capital. Something that I think is not going to be an issue for them, but definitely watch out for because it hasn't been as consistent as I thought it would be.
Yeah, it's kind of a double-edged sword here because when you're growing so fast, you have to invest more in the cans and working capital. So
right, you don't want a Zin situation that's happening right now. You'd much rather have a little bit more inventory while you're kind of hitting that S curve and 50% growth.
As growth slows, I imagine free cash flow conversion will become higher. With Monster's operating margins, I believe it has had to do with their international expansion and the lower price points on some of their energy drinks in those categories.
Yeah.
Question for you. Well, first of all, I'll say good summary on the unit economics. I think they're fairly straightforward for Celsius. The biggest issue would be if there was some sort of a huge switch in demand. Slowing growth is not the end of the world. I mean, it gets the stock cut in half, but it's not the end of the world in terms of like cash flow dynamics. If they had, for some reason, demand fell off a cliff, we almost saw this with like the whole someone had too many energy drinks and they I think they passed away. And it just so happened that they were drinking Celsius. And there was some articles that came out that were kind of like, I don't want to say hit pieces, but they were against Celsius. If something like that were to affect demand, then they'd be stuck with all this inventory they can't sell potentially. Then cash flow really starts to get hurt. But if demand just slows a little bit, I wouldn't be too worried. My question to you, who do you think has more room for price increases, Celsius or Monster?
I would like to see the comparisons at stores. I know I did a comparison on Amazon. I was kind of looking at a price per ounce but it's also not apples to apples because Monster usually has bigger cans. I would say Celsius slightly, but they both have solid pricing power. I don't think Celsius is going to be able to sell um, twice. It's not going to be like a iPhone versus a super cheap Android where you can sell for $1,200 versus $300. I think it's going to be more like, okay, Celsius might be $2.50 for a can. Another product is $2. Yeah, I'll just go with Celsius, but if it was at $5, I think people would really debate that. So I don't think they have unlimited pricing power, but I think Celsius is slightly better.
Yeah, I think that makes sense. Another way I could phrase this question for you: who do you think has a more affluent customer base?
Well, it's Celsius.
Okay.
Yeah.
Have you seen any sort of like demographic stuff about it?
No, they the management talks about it, and then that kind of matches up what you see in the real world.
Okay. So potentially there's more room for operating leverage here if you're Celsius.
Maybe, yeah, but I would watch that gross margin. It has ticked up. I'm not going to share the chart, but it's gone from like 38% to 50%. Just keep watching that because that's an indicator of how much they can pass on their input costs to customers.
Okay, let's talk about the Pepsi deal. I think about a year and a half ago, they signed a big deal with Pepsi, and Pepsi also got a chunk of the company as well. Talk about what this is and the importance of it for Celsius going forward.
Yeah, so there was approximately 2 years ago, and Pepsi and Celsius entered a large partnership. I'll just say what each side got. Celsius got $500 million in cash. They also got onto Pepsi's distribution network in the United States. And Pepsi now manages, I think, I wrote all, it's not all, but a lot of the distribution, which has likely contributed to better and more stable gross margins for Celsius. So positive for them. And also, Pepsi's huge. You know, you're going to get into that grocery shelf space, and Pepsi's going to negotiate for you with all of their leverage that they have at the grocery stores and convenience stores. And then third, they have opportunities to hop on the Pepsi distribution network internationally, where Pepsi gets first dibs on any new markets. And then what did Pepsi get? They got 1.5 million shares of Series A preferred stock. The preferred stock pays a 5% annual dividend, which was a $27.5 million payout in 2023. And then the conversion ratio is 1 to 15 for the common stock. So it's equivalent to about 22 million shares. Right now, there's 233.3 million shares outstanding. So about a 9.4% potential ownership by my math. Maybe a little different if I didn't do the total of
What do you
what it
think
would
of
be. But
that?
either way, the dilution would be decent, but not crazy.
Okay,
And it's not going to impact everything by too much if all goes well over the long haul.
what do you think of that 5% annual dividend?
Yeah, makes sense. Fine.
Do you think, I don't know, would you be frustrated if you were a Celsius shareholder and you saw Pepsi get that, would you be frustrated?
No, because it's $27.5 million a year is well worth having Pepsi. I mean, it's probably already been worth it for 10 years given the growth they had after that. Just because you're going to get the shelf space and you're going to have equivalent shelf space to Red Bull and Monster now and play on the same footing. They've gone up from when you're just competing to get 4 units at a convenience store versus a whole cooler or a fridge, whatever they are.
Okay, so you like the deal. You think it's
Yeah, I
quite
think
helpful.
it makes a lot of sense for both sides. Celsius is taking market share from PepsiCo products. PepsiCo, for example, owns Rockstar, which is a dying energy drink brand. There's also Gatorade that Celsius is taking share from, and this is really a hedge against that. They want exposure, similar to how Coca-Cola took a 20% stake in Monster, and Monster hopped on the Coca-Cola distribution network. Celsius would like better distributions in stores, which leads to revenue growth, and with those unit economics, it leads to more profitability. Now, what happened, and another reason why the stock is down, is a problem materialized this year with the deal. Pepsi overbought, or maybe Celsius oversold inventory into the distribution system in late 2023. This is why revenue growth accelerated in late 2023. I think it went up to like 100% from it had been going down for years at a percentage basis, and then it went up from like 80 to 100%. And people thought, wow, like Celsius had just even had almost $1 billion in revenue, going crazy here. But Combined with the category pressures of 2024, revenue growth has decelerated to 23.4% last quarter and may get worse this quarter. On a conference call or an investor conference this year, the CEO, or I think this was the CEO, but it was the CEO at another conference talking about this, said that Pepsi is about 55% of their purchases in North America. And if you look at their total growth this year, not the Pepsi, but Celsius's total growth this year, quarter to date, they're up about 10%. I think that might be, don't know if that's their revenue or the sell-through data. And when I mean sell-through, I mean the sell-through data to consumers, because Celsius recognizes revenue when it sells in to the distribution system, but consumers don't buy it until it's sold through to them. So there's a little bit of a mismatch on that. And they also claimed in the investor conference that their market share is up close to a point or 1 percentage point year over year. So one would assume that their purchases would line up with that growth. Unfortunately, though, that is not necessarily what has happened. And they said that they've purchased about $100 million to $120 million less in Q3 this year versus Q3 of last year. It's confusing. It's kind of hard to piece together. I don't think they know the full story yet, but essentially Pepsi is buying less right now to get that inventory levels down. That's going to make Celsius's revenue look worse, even though consumer demand is still growing. And you can see this with the revenue estimates chart. Nice little chart, I should say. I don't know when this was released, probably a little while ago, but from our friends at FinChat, which you should go check out with our link in the show notes. I'm going to share the screen. The estimates for Celsius's Q3 here is way off the trend and way below. So in Q3 of 2023, they had $385 million in revenue. The consensus estimate for Q3 of 2024 is $305 million, even though the company is gaining market share. Does that make sense, Ryan? And does that estimate, I know we're not in the weeds like these banking analysts, but does that estimate seem too low to you?
I would probably lean on the side of the analysts being closer.
But look how wide that skew is. Some are estimating like 400 million.
Let me pull up another chart, Brett, and I will say that feature is a little old, but still, yes, very useful feature. The revisions in revenue estimates.
Do they beat? Yeah, I'm not sure. I usually try not to pay attention to that, but I guess it
No.
might be helpful specifically in this case.
So this is what analysts were expecting over time for, in this case, 2024. So
Right.
they were expecting, looks like what is this?
2.5?
2.5
That's
for the
way
full
too
year.
high.
And now it has, over the last, 6 months roughly, since May, it's just fallen off a cliff. In terms of the expectations for revenue, it's gone from what they were at one point, consensus analyst estimates were projecting 2.5, a little under 2.5 billion in revenue. Keep in mind, they're currently at 1.3, 1.2,
1.4.
1.4. So almost double from here. It's since come down to roughly 1.7 billion expected.
Yeah. Yeah, that's because of this Pepsi deal. If we look at, according to management, Pepsi purchased around $120 million less this year. My guess is maybe the normalization is you divide that in half, where they bought a little bit too much last year, buying a little bit too little this year, and then we might add some growth on top of that. So you get $60 million, add say 10% growth, that brings us to $371 million if that consensus figure is correct. Personally, that feels a little low. You know, they had $385 million in Q3 of 2023. I would think it should be higher. But hey, who knows? Who knows? And either way, this is going to be an ugly looking quarter. And one of the keys for any investor in Celsius is looking for this normalization over the long term.
I think the biggest thing here is this a demand issue?
Yeah.
Because if it's not a demand issue, people will forget this ever happened in a year. If this is concerns over demand, then it's maybe a much, much bigger issue, and this is only the tip of the iceberg.
Yeah, I agree.
But I definitely skew on the side of This was a supply mix-up, not a demand issue.
I think so, yeah. And just listening to what they said, it makes sense. Pepsi was trying to catch up with the 100% growth Celsius was putting in, and they bought a little bit too much. And now they want to optimize cash flow, so they don't want to have too much inventory sitting with them. They're going to normalize this. And if you look at the market share data, Circana is not like in Celsius's pocket. So if that's low looking fine, then
we're kind of alternative data skeptics.
Yeah, but it's I mean, I think this one is one that's pretty trackable. It's been people use it across the industry. They're just tracking scanner data at convenience stores and grocery stores. It makes a lot of sense.
Yeah. Let's talk international expansion. What has happened here? And I guess getting to the punchline here, if you will, why has the international expansion been so slow? And do you think it'll change?
Yeah, this is a big question. Investors have really gotten nervous about this, or at least I think they have over the last few years. Revenue outside of North America is still under $70 million in the last 12 months. So under 10% of overall sales, well under 10% of overall sales. And I think this is explainable and not an issue yet. Celsius decided to focus on North America when it was smaller and quote unquote win this market before looking elsewhere. I like the focus. You don't want to spread yourself too thin when you're smaller, especially when North America is such a big market for energy drinks. I mean, why go after Europe when you're not going to have any focus there? I mean, how big's your team going to be when you're a tiny company, like 10 people in Europe? It just doesn't make any sense. Now, given their size, given their balance sheet, given their profitability, given the relationship with Pepsi and the relationship they're going to have with other distributors, they can run the Celsius playbook in new countries. And I think 2025 is a big year, a big test for international expansion. They have made deals for international distribution in Australia, New Zealand, the United Kingdom, Canada, and France. If they can execute the same strategy in these markets as they did in the US, there's a chance for international revenue to grow to a much larger portion of sales. All these markets combined probably have similar wealth / populations to the United States. So that could double the market opportunity, I would say. Maybe you'd have to include all of Western Europe, but still, I think, again, a huge opportunity if they can execute with the same playbook. I think that's really it. Yeah, 2025, I think, okay, from an investor perspective, 2025 should tell you a lot about what revenue growth should be from 2026 to 2028. Because if 2025 momentum picks up internationally and they go from like 1% market share in the United Kingdom to 3%, then I think that doesn't confirm, but it makes it much more likelier that they're going to go from 10% to say 15% or something like that.
Yeah, I agree.
Now, do you have any confidence in the Celsius brand going global? Like, that's kind of the thesis I laid out of what they're probably going to try to do. What do you think of the likelihood of the success there? Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks. Brought to you by Public Investing, member FINRA plus SIPC. As of September 26, 2024, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosure/bond-account for more info.
I think they can do it. I think they can have international success. A big reason for that is because you get a lot of Americans traveling abroad. You get a lot of places where they've already had success that are buyers there, that are moving there, whatever it is, there's some footprint of the brand already. And you have people in those markets that either travel to the US, they have it, they know of the brand. And I've seen this constantly on social media and stuff like that. Finally able to get Celsius at my store from someone in Canada or someone in the UK. And it's like they've been waiting for it. Now, maybe I'm a part of FinTwit, so maybe that's just shareholders that are just eager to try it. But I do think having brand success in the States, especially for a consumer product like this, where it's $2 to $3 purchases, can translate everywhere.
Yeah, if Monster can translate everywhere, why can't Celsius? Monster is, you would maybe argue, more unique American style brand with kind of the extreme sports. Like they're not doing those as much, I don't think, in France. Why won't, maybe to invert it, why won't a sugar-free fitness-focused product work in other markets? I don't see why not.
I feel like this is perfect for Australia. Without ever having been to Australia, it just seems like fitness, community,
Yeah.
warm. Like
They drink
you
too
need
much tea
this.
in the United Kingdom. It's too cold up there. Yeah, Australia, it's warm, it's refreshing. You could make sense. Make a lot of sense. Let's get that market going.
Do you trust management?
I think Fieldy has a fantastic track record. Well, I don't think so. He does. They were on the verge of bankruptcy when he joined. He was a part of the team that saved them. Remember, he said that they lost the Costco deal. That was 60% of their revenue. They were thinking they were going to lose their jobs in 6 months because the company was going to fold. And they pulled, I don't want to call it a miracle, but they had the odds stacked against him. He seems very sharp, focused on the right things in the interviews he talks about. And if we look at just the results, they have stayed focused on building the brand of fitness, health, sugar-free for a long time and are not stopping. They've also been very good at not wasting money on acquisitions, at least to my knowledge. Making a
I,
deal with PepsiCo is smart and should not lead to too much dilution. So the one deal they made was with one of their biggest competitors and making a friend out of an enemy that they're stealing market share from with a lot more capital and a lot more firepower and power, just power in general.
I don't know if it was an acquisition, but I know at one point they were trying to sell like food, like protein bars,
Oh,
that kind of
really?
thing in Europe specifically.
Yeah, well, good thing they're not doing that anymore. I think the GQ interview was good. I think there was a lot on his philosophy and how he runs the business. I came away thinking he's not a consultant mouthpiece, and that's good. Doesn't mean they're going to succeed from here, but the execution has been phenomenal, and I don't see any reason why I shouldn't trust them. Like, why should I doubt them right now after he's 100x revenue in a decade? I don't know.
What's the insider ownership look like?
He's at about 1.5%. I guess I don't have the table in front of me. We also have like Pepsi, is technically a part of that. There's an investment fund that made a big investment in them. I think back when they were about to go bankrupt, and they still have an
Yeah.
ownership stake.
Li Ka-shing. I don't know who that is, but
I
owns
think that's
4%.
yeah, I'm not sure. You'd have to look at the footnote there, but someone, again, Fieldy owns about 1.5%. There's an investment fund that has a stake. Pretty standard. Besides that,
All right. Let's talk competitors. Any chance this is just a fad? And then do you worry at all about copycats?
I mean, I worry about both those things, but that's why we do the research on this episode, to try to mitigate or maybe look and see if we're being too worried about them. Because how could you not be worried when you've seen the LaCroix boom and bust, and you've seen what was the biggest one? The White Claw boom and bust. Now, both those products are still in use, but
Different categories, I will say. And
different categories, but I would say similar.
one big differentiator, these have caffeine,
Yeah, that's true. That's true. But
which is addictive.
I still think those are examples of where people should be cautious about extrapolating revenue growth forever. They've taken a share from everyone else. They're now a $1.5 billion revenue business, basically solely in the United States. And given the great unit economics we talked about, capitalism is doing its thing. Competitors are emerging on a regular basis. There are a lot of potential profits to be had if you can steal them back from Celsius. You have influencer-backed brands, other new healthy energy upstarts. I always put those in quotes because it's really just caffeine and seltzer water. And then competition from Red Bull and Monster trying to hit on the sugar-free category. I am not worried about Red Bull and Monster because they can say like sugar-free Red Bull or Monster sugar-free, or that new thing they have with Monster called Rain. Monster also owns Bang. Bang Energy, which was popular, I think maybe 5 to 7 years ago, something like that. And that's been struggling a ton. And I just think the perception of those brands is not going to be fixed. And they don't really, this is the it's not innovator's dilemma because it's energy drinks, but it's counter positioning is the right way to say it, where Red Bull and Monster can't destroy their existing brand to go after this niche, and it's a growing part of the energy drink niche, and it's going to be tough for them. But what about these upstarts like Alani Nu, which is getting a lot of share? I think it has about 3% share. I have a chart or a screenshot here where it's getting sold on Amazon. It looks very similar to the branding of a Celsius. It says, and I'll just have the title here: Alani Nu Dream Float, sugar-free, low-calorie, 200 milligrams of caffeine, pre-workout performance with antioxidants, biotin, B vitamins, zero sugar, 10 calories, 12 fluid ounces, and it costs slightly more than a Celsius, but about the same price. Celsius says, functional essential energy, B vitamins, blah 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 blah. It's pretty much a copycat. And then I want to share this one, which I think is interesting. It is the year-to-date market share for all the energy drink brands. What's nice about Celsius is that they just put all their competitors on their investor relations slides. They don't have to do this and pay an investment bank a ton of money, which I wouldn't do it anyways. But Celsius has gained $425 million year-to-date versus, I think, the year before. Monster's actually lost dollars spent. Bang has lost dollars spent. But if you look at these ones like Alani Nu and C4, which I guess C4 has kind of reinvigorated its brand, Alani Nu has gained $122 million and has 3% share. So I think they're definitely taking potential Celsius customers. Does that make sense, Ryan? I know it's a lot of numbers, a little confusing, but it's basically a copycat product, and they have 3% share.
Yeah. Probably nipping at the heels of Celsius. I'd say C4 is probably in the same boat, where especially Celsius now is kind of more of a broad brand in that it's not, people don't necessarily think about it as purely like the fitness pre-workout kind of drink, but C4 looks like they're at 3.3% share and they gained $104 million. That's probably targeting the fitness enthusiasts as well at a lot of those gyms and stuff like that. So
C4 is, I think, I'm not sure many women drink that one though.
No, probably not. I would assume
a lot of guys.
Yeah,
But the old formula used to be dangerous. As a side note.
Anyway, yeah, Alani Nu is concerning. Question for you: How much do you think this weighs on the stock? Alani Nu's success. Yeah. I imagine a lot of people see that and they're like, I can't invest because there's going to be more of these that come along.
Yeah, I think that's what we should put for our quote for the tweet. Alani Nu is a concern. That's just kind of a funny little quote. Like, I don't know. I bet none of FinTwit has heard of that brand, or 90% of them haven't. But it is a concern. I think the Amazon Marketplace, if you look at those little screenshots they'll have in the newsletter there, they look equivalent. There's a lot of sponsored listings. If you search energy drink, you get dozens of products that look very similar. A lot of them are trying to copy Celsius. I don't know how they separate themselves as like introducing themselves to the consumer on Amazon. But the good thing is that this is a small part of the market. I do believe they have a brand build up and can fend off competitors due to the deal with Pepsi, because distribution at stores matters a lot. They're going to show up front and center for the shoppers. And Alani Nu does not have this luxury. If I go to the grocery store, I'm confident Celsius is going to be right there. I've never seen Alani Nu at the store.
I have.
What about you? You have?
Yeah. I've been enticed by it.
I know it looks similar.
They just copy Celsius.
Yeah.
I don't know.
Well,
and they have the same like healthy, less intimidating vibe.
Yeah. Now, that is a concern, and we do sound a little bit negative on this competitive set. It's definitely probably the biggest negative I've seen when researching the episode. Like the macro stuff, I don't really think is a problem. I don't think that the Pepsi thing is going to work themselves out. But haven't there already been a lot of fitness and health energy drink copycats for the last 5 years, right? This company's been around and they still have over 10% market share that is growing. You could have probably made this same argument back when Monster got started if Red Bull was a public company and said, well, look, they're stealing market share. But the category itself is growing, and not one company is going to dominate the whole thing. My discussion question, though, We're at about a little over 10% market share right now with Celsius. What market share do you think they can achieve in the United States, and what confidence level would you put on that?
I think they can. Like, I think it's possible for them to achieve 30% if they get. Wait, sorry, in the United States specifically?
In the United States specifically with market share. Yeah. Right now it's at 12.
Yeah, I'll probably still go 30%. I mean, if they can retain that 40%, 40 to 50% of new dollars spent, they're going to get there
That is true.
over a
That is a
long
good
enough time
point.
frame.
What's
Yeah, I
I'd
would
say my
not
confidence level
underestimate.
though.
I think they're going to have a lot of success in the United States. I mean, they already have, but I think they are going to continue to have success in the United States. International, it's a different question. I'm optimistic that they can, and I probably lean towards them succeeding more so, especially if they commit the resources to marketing the same way they did here. Yeah, I really think they can get to the Red Bull monster levels.
Yeah, 30%, they would be stealing a lot of market share from them, unless you think it's going to be only those three and then 10% and less for everyone else.
No, I would not be surprised if Monster and Red Bull lost some market share.
Lost a little bit of
In
share.
the States.
Yeah. Yeah. No, I agree with you. I think I would have, I know fairly high confidence isn't like a precise metric, but I would have fairly high confidence they can get to something like 20%. 30%, I think they can get there, but I don't know if I would say I'm betting big on that happening. And good thing is, like, that's pretty far away from here.
All right, let's talk valuation. Is the stock cheap? Obviously, the stock is down nearly 70%. So is it cheap? What are your financial estimates? And will you be buying shares?
Yeah, it's definitely cheaper from a price perspective.
Relatively speaking.
Yeah, relatively speaking. The one thing we want to, like, the two numbers I want to hit on are like what I think revenue growth will be for the next 3 years, and then what margins can be like from an operating margin perspective. It shouldn't, that dividend payment and then any interest expense / interest income shouldn't impact it too much. So I think EBIT margin, operating margin should convert over time to cash flow. My estimates, I would say, what I have fairly good confidence in is growing sales by about 20% annually from 2024 to 2027. So what I mean by that is like from the end of the year 2024 through 2027, and then maintaining a 25% operating margin. And the reason is the energy drink category should continue to grow over the long term. The Celsius brand is taking share within that category. And in international expansion, they have a low hurdle to gain share. Like, even if, as you mentioned, replicating the playbook to perfection, even if they don't succeed as well internationally as they did in the United States, they are way below any sort of success level right now. So I think that can lead to, 20% annual revenue growth. I think we also shouldn't remember, or sorry, mixing that up. We also shouldn't forget the preferred shares. So I'm adding that to the fully diluted share count, and we get a market cap as of this recording of about $8.2 billion at the current share price. And in my assumptions, I kept the share count flat from 2024 to 2027. I assume they're going to be positive on a free cash flow basis. So I'm just going to assume that they're going to repurchase the stock to offset dilution. It's just part of the model. Not sure exactly what they're actually going to do. Under these assumptions, the stock trades at these price to operating income levels from 2024 to 2027. 24.9, 18.2 in 2025, 15.2 in 2026, and 12.7 in 2027. Under those estimates, I think it looks fairly cheap.
So you're saying if revenue over the next 3 or 4 years grows 20% a year, operating margins are at 25%.
Yeah, they're over 22% now.
It's trading at 13 times roughly 2027's operating income.
Yeah, with the stock down, it's actually 12.5 price to operating income on 2027. Yeah, here's the question: is that cheap though? Is that cheap? That's
I think that's
over 3 years out.
reasonably valued, is what I would.
Yeah.
Forecasting 20% growth, that is,
Yeah.
I don't know if I'd call it cheap yet.
All right. Last question though, and this is the what I call the actionable stuff from the episode. I left this one blank because I didn't want you to be spoiled, but I guess we're gonna decide whether I'm gonna purchase shares. Oh, here's what I'll ask for you, because I kind of want to break from talking. I talked a lot this episode. Are you more bullish or bearish after this research?
I'm more optimistic on the durability of the brand. I would have thought, just purely because it was a 70% drawdown, that the stock would be a little cheaper.
Yeah, that's a good point.
I mean, it's still baking in basically 20% growth annually.
Yeah, I wouldn't be surprised if 20% growth happens. The stock trades at like 20 above 25 times earnings. But again, you're banking on that from a multiple expansion perspective. So that could lead to some, I guess I don't have the numbers in front of me. I think that is not necessarily all priced in right now. But yeah, it's not like, oh, okay, it's going to trade at 5 times earnings in a few years. Wow, that's incredibly cheap, and it deserves to trade at 20 times earnings. You know,
Yeah.
13 times earnings in 4 years is not something where you go, oh my God, this is dirt cheap.
Yeah. Are you going to buy shares?
I'm undecided, so that means no. I'm not.
It's going to be real high on the watch list.
Yeah,
Need another 70% drawdown.
I know it's very close, and when I get to this point and I get undecided, I have to just remind myself that there's a lot of stocks out there, and if you're undecided, you're probably undecided for a reason. And for me, it's a little bit on the competitive set and also a little bit on the valuation where I don't think it's as cheap as people think. Now, the stock could absolutely rip 50% next quarter if this Pepsi situation is overrated, and I might look like a fool. But I think, and these are the cursed words out there. Another 20 to 30% down, I think it looks quite attractive. But if I compare this to my existing portfolio, I don't think it's as cheap, even considering 20% annual growth.
I know it's hard to fathom that after a 70% drawdown, valuation is still top of mind as a concern for us. But
Yeah.
You still got to forecast pretty strong growth. And it was a lot easier when they were growing 100% year over year to think, oh, they could grow 20% annually. But 20% top line growth for a business this size is a lot.
I agree. And I don't want to hear anything in anyone's, well, don't be thinking this. Well, the S&P is at 29 times earnings. I don't care what the S&P is trading at. I really don't. I don't care that Celsius is trading at a cheaper multiple than the S&P 500. I care about what returns I'm going to get owning the stock. And I think the risk reward is pretty dang close to being a great opportunity, but not necessarily yet.
All right, I think that's going to do it. What are some of the risks you're keeping an eye on?
Yeah, here's a little sum things up for big takeaways. If you own the stock, if you're interested in it, I'd really keep an eye on the Pepsi situation. I'd keep an eye on market share stagnation. This summer, they haven't grown market share by that much. It's a short time period, but I definitely look for that to keep happening in the United States. That's going to be, if they can't gain any market share from here, that 20% annual revenue growth is going to be tough. And the third one is the category growth. There's been a slowdown this summer. We'll see how long that happens and whether it's a permanent shift. Like, it's not out of the realm of possibilities that the energy drink category as a whole hit a little bit of a ceiling.
Yeah, that's fair. Hit maturity faster than people were thinking.
Yeah, and then as Ryan mentioned, Alani Nu, a little bit of could be a problem.
Yeah, it honestly could. All right, I think that's going to do it. You want to take us out or you want me to?
Yeah, I'm trying to think anything else for people to remember. Just remember we recorded this on September 25th, 2024. And also remember, we talked a lot of charts, a lot of numbers. That'll be in the newsletter. It's free, goes along with every episode. And yeah, why don't you take us out with the disclosure?
All right, that is going to do it. Thank you all for tuning in. I will have another stock-specific episode coming out in a week after this one. And I don't think I'm going to name the companies, but we're talking about two different types of grocers. One is
Wow, sexy.
one we've had a history with, and a multi-bagger, I will say. A little foreshadowing there. But thank you all for tuning in. Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Stocks is not formal advice or a recommendation. Brett or I may buy, sell, or hold any of the stocks discussed on this podcast. Thanks again for listening to this episode, and we'll see you next time.